On February 21, 2019, Jeffrey Skilling walked free after spending 12 years behind bars. He was the mastermind behind the biggest financial fraud of the 20th century. Enron's leaders wiped out $74 billion of investor money, destroying thousands of lives and shaking the U.S. economy. Enron's success story was truly incredible. The company's top management came up with such innovative ways of doing business that in just 4 years, its revenue skyrocketed by 750%. By 2000, its stock price shot up to $90 per share, and its market value soared past $70 billion. It was unheard of. Enron was hailed as the crown jewel of Wall Street and a symbol of America's economic progress. Back then, no one had a clue about the ugly truth hidden behind its polished financial reports. To suspect something was wrong, all you had to do was compare Enron's revenue with that of any other energy company. While others grew at a steady 2 to 3% per year, Enron was expanding at an astonishing 65% annually. Moreover, its cash flow was far from stable. It spiked sharply every year in the fourth quarter, almost as if on command. Suspicious? Oh, absolutely. That's exactly what Jim Chanos, a hedge fund manager at Kinnikos Associates, thought. His statements caught the attention of Fortune journalist Bethany McLean. In March 2001, she published an article titled, "Is Enron Overpriced?" And that was enough to set the snowball rolling from the top. Wall Street analysts started demanding explanations. Enron's leadership grew nervous. In 2001, during a conference call, an analyst asked about the company's actual earnings. Instead of answering, Enron's CEO snapped at him live on air.
Well, thank you very much. We appreciate it. Asshole.
Almost immediately after that, an official investigation was launched. Within a year, Enron's CEO resigned, the vice president shot himself, and the company's stock price plummeted from $90 to just $1. By December 2001, Enron had filed for bankruptcy. It was absolute madness. It turned out that Enron's dazzling financial success had been nothing but an illusion. Estimates suggest that shareholder losses ranged from $60 billion to $74 billion. Tens of thousands of people lost their savings and jobs. And how did Enron's chairman, Kenneth Lay, react? He was very surprised.
Certainly, we're surprised. I think probably even more appropriately to say we're shocked.
But can we trust this guy? Nope, we don't. Hit the like button if you're also doubting his sincerity. The investigation revealed that Enron's entire top management knew about the fraud. Kenneth Lay himself was charged with fraud but died of a heart attack just before sentencing. CEO Jeffrey Skilling got 24 years in prison. CFO Andrew Fastow got 6 years, and in total, 19 high-ranking executives were convicted. But you know who wasn't on that list? Enron's vice president, Christian Rasmus Holmes IV. He somehow dodged charges in the biggest financial fraud of the 20th century. And 20 years later, his daughter pulled off the biggest financial fraud of the 21st century. What a coincidence. By the way, we already have a video about Elizabeth Holmes on our channel, so make sure to check it out. But for now, let's dive into how Enron's top executives managed to fool the entire world and illegally pocket $74 billion. The first key to success is deregulation. In the 1980s, the U.S. started loosening control over the energy sector, and by 1989, the Natural Gas Wellhead Decontrol Act fully opened the market. Gas was now sold through middlemen, and Enron jumped at the opportunity. But soon, price volatility skyrocketed, hitting consumers hard. Politicians pushed for new regulations, but Enron, fearing losses, poured millions into lobbying. The company secured backing from powerful figures like Phil Gramm, Karl Rove, and Harvey Pitt. Enron's founder, Kenneth Lay, was a close friend of the Bush family, donated to George W. Bush's campaign, and was even considered for energy secretary. Thanks to these connections, the company managed to dodge government sanctions.
Just kind of a general discussion. I have not met with him personally.
But Enron's golden age of making money was still ahead. The real fraud revolution in the company was led by Jeffrey Skilling. Smart, charismatic, and persuasive, he joined Enron in 1990 and introduced an innovative accounting method. Enron became the first non-financial company allowed by the SEC to use mark-to-market accounting. Apparently, connections played a role in that decision, too. Mark-to-market accounting meant that instead of reporting actual earnings, the company recorded expected future profits. It didn't matter if the money would come in 10 or even 20 years later. Whenever Enron signed a contract to build a power plant, they immediately reported the profits it was supposed to generate. This imaginary income instantly inflated the company's value, created the illusion of explosive growth, and attracted new investors. Unfortunately, everything can change completely in 10 years. Laws, gas market prices, and relationships between buyers and sellers. Contracts can be broken, partners can go bankrupt, and all of this could wipe out the profits Enron had already recorded on its balance sheet. But if the company wasn't making money from past deals, how could it keep attracting new investors? Of course, by promising new deals. Sometimes it reached absurd levels. In budget meetings, Skilling would first determine how much profit the company needed to attract investors and boost stock prices. Then, reports were adjusted to match the desired numbers. But you can't mislead people forever. Sooner or later, analysts would ask the crucial question.
Why it was that Enron, as a financial services company in effect, could not release a balance sheet.
To show clients at least something, the company brought in an army of certified accountants. Enron churned out stacks of complex financial reports designed to confuse shareholders and analysts. And to hide its debts, CFO Andrew Fastow created an entire network of fake companies. The scheme was simple. First, the parent company sold a losing asset to a shell company. Then, it reduced its ownership stake in that company to below 50%. This allowed Enron to legally leave the shell company with its negative balance out of its financial reports. As a result, shareholders saw imaginary profits but had no idea about the real debt. By the time the truth came out, there were already hundreds of these fake companies. But even that wasn't enough for Enron's leadership. To confuse investors even more, Jeffrey Skilling kept pitching new projects and putting on a show of non-stop business activity.
Today, you'll experience some of the most successful solutions provided by EGS people.
Enron tried to be everything at once: an investment firm, a hedge fund, even a tech company. They launched the Enron online trading platform, bought gas pipelines, power plants, paper mills, and water treatment facilities. They even struck a deal with Blockbuster Video to break into the entertainment industry. To keep investors convinced that business was booming, they went to extreme lengths, including staging fake office tours for analysts. In 1998, for example, analysts were given a tour of Enron Energy Services. It was all a massive show. Employees from different departments were crammed into one space and told to pretend to be busy. Seeing a buzzing, thriving office, analysts walked away convinced that Enron had a brilliant future. But that bright future never came. Once the fraud was exposed, Enron moved from hiding debt to physically destroying evidence.
Without our knowledge, without the knowledge of the legal counsel, that meeting was called and they proceeded to destroy documents.
In just a few weeks, over a ton of financial records, emails, and documents were destroyed. Corporate communications were erased. Hard drives were wiped clean. Some even believed that witnesses were physically eliminated. At the start of the investigation, former Enron Vice President Clifford Baxter was found dead. The official story? He took his own life to escape accountability. But insiders suspect he knew too much and could have testified against top executives. He never got the chance. Looking back from 2025, it seems like only a blind person could have missed such a massive fraud. But let's not forget what America was like in the 70s and 80s. The country was in crisis, facing a brutal energy shortage. Gas supplies were uneven, and in the Midwest and Northeast, schools and hospitals risked shutting down because they couldn't heat their buildings. When Kenneth Lay entered the gas market, he played on America's fears. Enron promised affordable energy and a stable, happy life. People wanted to believe, so they did. Can we really blame them for that? As long as Enron's gas deals were legitimate, the company actually did a lot of good for the U.S. energy market. But over time, their deals became more and more outrageous. Still, Enron had built a solid reputation, so people looked the other way. But fooling everyday shareholders is one thing. Deceiving auditors is a whole different game. After all, auditors are supposed to ensure financial transparency. So did they really not notice the fraud? Finance expert Bill Hanna is certain they knew exactly what was going on, and they were even part of it.
As far as who's accountable for this disaster at Enron, too, you have to think of the auditors, which at the time was the firm Arthur Andersen.
Arthur Andersen was one of the top 5 auditing firms in the U.S. The market had no reason to doubt their reports, but they should have. Investigations revealed that Arthur Andersen approved even the craziest deals because Enron had been paying them off since the late 80s. In 2000 alone, the auditors received $25 million for auditing services, plus another $27 million for consulting. And what about the banks? Did they really not notice that the biggest energy company in the U.S. was running a massive scam? Enron shareholders are convinced the banks knew everything. Merrill Lynch, Credit Suisse, and Barclays made millions in banking fees from Enron. If they had exposed the fraud, they would have cut off their own profits. So they looked the other way. It seems like everyone was in on the scheme, even Enron's own employees. FBI Special Agent Michael J. Anderson recalls,
Enron was a company where it was okay to lie, it was okay to cheat, as long as you were making money for the company.
Skilling demanded that employees constantly falsify reports. Those who were the best at cooking the books were rewarded with cash bonuses and stock options. At Enron, the most innovative ideas were the best ways to manipulate financial statements. Department heads at Enron were paid twice as much as their peers at other companies, and it seems like they were willing to lie twice as hard to keep those paychecks. If employees refused to participate in fraud, they were blackmailed, fired, or silenced. When Sharon Watkins, Vice President of Corporate Development, tried to expose the fraud, Enron tried to discredit her and convince employees that she was a traitor. But was it possible to stay silent about the company's corruption without being part of it? Not a chance. Enron used a system called rank and yank. Every quarter, the bottom 15% of employees were fired. This culture of fear eventually forced even the most honest employees to start falsifying reports just to survive. But there was one more thing. To make sure employees were personally invested in Enron's success, the company forced them to buy Enron stock. When the company collapsed, 20,000 employees lost everything: their savings, their pensions, their future. At least we can take some comfort in the fact that Enron's leadership didn't get away with it. As we know, the entire top management faced well-deserved punishment. But does that mean the story of Enron is truly over? Not quite. In December 2024, the Enron brand suddenly reappeared. Ads in the Houston Chronicle, billboards across Houston, internet commercials.
We are Enron.
But don't worry, the scammers aren't back. Turns out, the Enron brand was bought for $275 by satirist Connor Gatos, the same guy behind the viral conspiracy Birds Aren't Real. Now he's using the Enron name for performance art, mocking toxic corporate culture and shady business practices. So, what do you think? Could Enron ever make a real comeback? Or is a fraud on this scale impossible in 2025? Drop your thoughts in the comments, and don't forget to subscribe so you don't miss our next episode.